Welcome to another episode of Kiss My Assets.
The transparency, the openness, the communication is more than you could expect. I'm sold.
Don't let the fact that you don't know something or don't know enough about something hold you back.
I knew I wanted to invest. What better way to invest than to invest in what I already know that I love, which is real estate.
It was initially the 12% return, but it quickly turned into the people.
Hello and welcome to an episode of Kiss My Assets. I'm here with Jamison Manwaring, CEO of Neighborhood Ventures. My name is Grayson Lupus. I am a college student and digital marketer here at Neighborhood Ventures. And today we're going to talk about how Neighborhood Ventures picks their investments. I'm sure people are wondering, I'm curious how you guys pick your investments, pick your properties. So why don't you walk us through just a quick broad overview and then we can dig into some details later of how you guys go about, what's the first step when a property comes your way? How does a property come your way? Walk us through it.
Yeah, I kind of look at it like a funnel where you need to look at a lot of potential opportunities. And so we're constantly looking at deals, as they're referred to in the industry, or properties.
Mm-hmm.
We know that we need to look at typically about 100 deals to find one that we move forward with.
To find one you actually end up closing on?
That we'll end up acquiring. And there's a lot of things that happen in that process when you're actively looking. You're better able to see what's happening in the market. You're able to see what you like about deals, what you don't like about deals. You're able to really fine-tune what is happening in different neighborhoods. And the thing with real estate is it's always changing, especially in a dynamic market like Phoenix. Prices are changing, neighborhoods are changing. There's new development happening that can really be a catalyst to a neighborhood. So that's kind of what I would start out with by saying is we're always looking.
Mm-hmm.
And to just take a step back for that, in order to see 100 deals,
Mm-hmm.
you have to have a pipeline of relationships.
So that comes from relationships with people like ABI and other brokers and
brokers like ABI multifamily, other brokers, relationships that we have in the Valley. We also, my co-founder John has a lot of relationships with apartment owners,
mm-hmm.
and so if they're looking to sell, they'll contact him.
We have people like Chris who are in-house and they're constantly looking for deals like retail deals.
Yeah, and that comes by having broker relationships.
Mm-hmm.
So, a lot of us may be familiar with the MLS, which is how you find a residential home to buy.
Yeah.
And all of the data that goes in the MLS is really a powerful database that anyone can access. And the other thing that it does is it really gives you an idea of what's happening in the market at any time. You can go in and look at comparable sales. Yes.
You can see all the pictures and see what properties are selling for, what the renovations look like, so how you can renovate your house.
Right.
Apartments, I'm guessing, aren't quite the same, right?
So what I would call the MLS is an efficient market. It's almost like publicly traded companies,
mm-hmm.
where we have all these rules in place so that publicly traded companies can't have inside information that gets outside of the company so that a potential investor could act on that. So that's what we refer to as an efficient market, meaning the information's available to anyone. It's just a matter of finding it. And that's really what the MLS provides in a way for single family homes. With apartments, it is not an efficient market, meaning there are all kinds of transactions that occur that never go on any sort of marketing. They're private party transactions, off-market transactions, as we refer to them. And a lot of times that's where you can get your best opportunities as a buyer is in an off-market transaction.
So you get a better deal if it's off-market, because if it was on-market, then everybody who wants to buy apartments would be looking at that same property, right?
Yeah, it's an opportunity to buy a property by engaging the seller directly. And a lot of times sellers, especially of commercial real estate, which includes multifamily, includes retail, includes office, that collectively is called commercial real estate.
Mm-hmm.
Commercial real estate, typically the sellers don't want to have a lot of disruption that comes from selling and marketing a property.
Yeah.
So let's just say you have an apartment building with 100 people, 100 units, and 5 people working there. You don't necessarily want everyone to know that you're selling it.
You know, people walking through and taking pictures because you have tenants, and
They have tenants who live there.
legally you can't even walk in there and take pictures, right? During a
You
tenant's.
can. So if you're an apartment owner, you give them a notification. You
Yeah.
can go in and look at it.
But if it's sort of a private deal where it's not on the MLS, on an MLS type market, then you can go in and it's more private. It's less, you don't have, instead of 100 people walking around looking at the same building, it's just Neighborhood Ventures or maybe one other company.
Yeah. So for a seller, it's more advantageous to do that a lot of times with commercial real estate, to just engage a party like our company directly,
Mm-hmm.
where we would buy it. We're not going to make a lot of hoopla. There's not going to be a big for sale sign in front of the building.
Yeah.
And that's why they're more common in commercial real estate transactions. Same thing is true with other real estate that, if you have tenants there, if you have folks who are paying you rent, you don't necessarily want to bring all this distraction and uncertainty into their lives. So if you're potentially going to sell that, you typically wait a little bit until you make sure this person's going to buy it. You make sure that they have financing in place. Then you'll let the residents know. But that is an important component of starting to build those relationships too. But because to see 100 projects, 100 potential opportunities,
Yeah.
you really need to have a pipeline of folks who are helping you see these projects.
So what's the next step? Let's say you get those. I know they probably don't all come in at once, but for this hypothetical situation, you get 100 deals in the pipeline. What happens next? How do you then go from 100 to maybe 50 or and then you start narrowing it down? What is that like criteria that you nail it down to? Like, we want this and not that, or how does that work?
Yeah, and I would kind of compare it to somebody who's looking to buy a house or looking to rent an apartment. You go online and you start looking, and pretty quickly you can say, okay, I've looked at 100 apartments or 100 houses, or in our case 100 commercial buildings.
Mm-hmm.
You can pretty quickly narrow that down to probably 10 or 15 within that stack that in the area you want. From a high level, quick overview, it matches what you're looking for.
Mm-hmm.
And then at that point, you've narrowed it down to, call it 15% of the pool.
Mm-hmm.
And then you do a bit of a deeper dive from your desktop. That's what I call it, where you start to do some more research based on public information available. You're looking it up on satellite images. You're trying to understand what's happening in the neighborhood. You're looking at news articles.
Mm-hmm.
High level, but it can be done from your desktop.
Yeah.
And then the final step is going out and doing some hands-on, boots on the ground sort of research, driving around the property. And this is even before you go inside the units, driving around the property.
Yeah.
Sometimes you'll try to get out and walk it, go see what the public common areas look like.
Yeah.
If it's a retail building, go park there and see how many people are in the stores, seeing if it's an active retail area. And then after you do that kind of desktop research and then the boots on the ground research, usually maybe you're down to under 10 potential projects that fit that criteria. And at that point, we also do, as part of the desktop research, we do a lot of financial analysis. What is the rent in the neighborhood? What's the current rent of the project?
Mm-hmm.
And are there opportunities there to take the project rent up because it's below the market? And so for us, our strategy is we're looking for investments that have properties that have rents that are below the current market. And then we find ways that we can make changes to the property so that the rent can be increased to what the market is currently paying.
Okay, so when you increase the rent like that, how does that work with the property value? Because I know your guys' strategy is usually to go in and make intelligent renovations, and then eventually sell the property. Generally, you don't hold on to it for long. 3 to 5 years, is that usually the timeline?
Yeah, it's actually 2 to 3 years.
2 to 3 years. So how does that work? Let's say the rent is $800, it goes up to 1,000 or something like that. How does that increase and work with the property value when you guys go to sell it?
Yeah, so from a financial perspective, an investor perspective, you have fixed costs on a property.
Mm-hmm.
You're going to have your debt payment. You're going to have a mortgage payment, the mortgage payment, same as the debt payment. You're going to have taxes. You're going to have maintenance. Sometimes you pay the utilities. You're going to have landscaping, all of these things. You're going to have insurance. And the real opportunity with real estate is those fixed costs don't change if, in the scenario that we're talking about, if people are paying $800 a month and you can now get another $200 per unit,
Mm-hmm.
that is pure profit.
Yeah.
Because it doesn't increase your mortgage. It doesn't increase your insurance. You have brought pure profit to the bottom line by finding ways where you can get a higher market rent for those units. So if you buy a project that you have a plan to increase those rents, it makes a lot of sense financially that over a year or two, those rents can move up. Your net income for the project moves up as well, because your fixed costs, they do move up slightly, but it's not near as much as what rent does.
Yeah.
Your insurance will move up every year. Your taxes move up a little bit every year. But broadly speaking, those are fixed costs. So the additional income you can bring in falls right to the bottom line, right to the net income. And that's how you determine what a property's value is how much net income, operating income, is this asset generating.
So I'm guessing when you guys go to do your due diligence in that process, once you kind of narrow it down from 100 to 10, you start to get more into the details of the property. I'm guessing you guys are really looking at how much can we boost the rent from where it's at to what the market will support now.
Yeah. In what ways is this property deficient,
Mm-hmm.
so that it isn't generating the current market rent? And if we can make those changes, it will go to the market rent. We're not going above the market rent. We're just trying to find properties that have deficiencies that we can fix. And so as we get through this funnel, we are looking for properties that are in these up-and-coming neighborhoods where we're seeing transitions happen. So, for example, our Broadway property, right across the street, it used to be a big parking lot. And it was very kind of an industrial feel. Not a lot of retail activity, not a lot of residential activity.
Yeah.
But we knew that the property across the street had been sold to an apartment developer. And now they've developed 330 luxury units right across from our retail building.
Wow.
So that's an example of an up-and-coming neighborhood.
Yeah.
So we're looking for an up-and-coming neighborhood. We're looking for properties that have below-market rents that we can go in, adjust, reconfigure the property, whatever we need to do to get to those market rents. And then we find properties that are kind of in what we call our middle market. So we're not buying fourplexes, we're not buying duplexes.
Yeah.
And now we probably wouldn't buy something under 20 units, but all the way up to about 150 units.
Mm-hmm.
This is kind of the mid market. There's less competition for these buildings.
Mm-hmm.
Because big institutional buyers, Goldman Sachs, my former employer, other big funds, they don't come in and buy 100-unit buildings. They want to buy 500-unit buildings.
Yeah.
Because they write a big check. But these medium-sized buildings are a really nice niche for us. We can go in and buy them, do our thing, and have a really nice profit. So once we go through that funnel, if they meet those three things, we're going to move on it.
Mm-hmm.
And we have a very clear investment thesis that hasn't changed since we started 4 years ago, that those are the three things we're looking for. And if they match it, we're gonna move forward with it.
Yeah.